Okay, here's a big question for you. Can faith actually change the global economy? I mean, can a shift in political ideology, like really deeply held beliefs, redraw the lines for how we spend money or even how countries trade?
It's a fascinating question. For decades, right, a lot of investors really tried to keep politics out of their portfolios. Separate those religious values from the hard market reality.
Yeah, build a wall between them.
Exactly.
Yeah.
But based on the material we've looked at for this deep dive, well, it seems pretty clear that era of separation is officially over.
Okay, so what are we seeing then?
Well, what's interesting is we're not just looking at like abstract political ideas floating around. We're tracking two massive and accelerating shifts. One's right here at home, the other's international.
And these shifts involve core values dictating economic results.
Precisely. Whether those values are religious or, say, geopolitical, they are directly shaping hard economic outcomes now. Things like where profit is actually made and, maybe more importantly, where risk is piling up.
Got it. So our mission today is to cut through all that complexity. We want to find those actionable nuggets, the things you really need to know to navigate these new landscapes.
Right.
We've got two big stories, pretty complex ones. First, here in the U.S., how quickly conservative Christian values are becoming, well, institutionalized within the government, and the direct, tangible effects that's having on rules, regulations, and even how the market splits.
And the second story.
That takes us to China. It's got this kind of split personality right now. On one hand, you have this booming state-backed manufacturing renaissance, but on the other hand, surprisingly wary consumers really hesitant to spend.
Okay, two huge topics. Let's unpack how these shifts are basically creating mandatory new filters you need to think about for your investment decisions.
Let's start stateside then. The source material really confirms what a lot of people have been noticing. The Republican Party's shift towards being, well, more explicitly defined as a Christian party. It's moving past just talk now.
Yeah, it's entering a phase of institutionalization. That's the key word. It's being built right into the federal government structure.
Yeah.
This isn't just campaign speeches anymore.
Institutionalization. So that means what? Making it official?
Prominent. That's the critical point, yeah.
Yeah.
Institutionalization means creating official government bodies, permanent ones, and also setting up judicial support systems. The whole idea is to embed this ideology deep into the bureaucratic machinery of the government.
And we're seeing concrete examples of this.
Definitely. We saw two really key moves this year that formalized this support.
Yeah.
Back in May, you had the president establishing the Presidential Religious Freedom Committee. That was by executive order.
And that's not just some advisory panel.
No, not at all. It's a formal body. And its specific design is to inject these conservative Christian values directly into federal policy across every single agency.
Wow. Okay. And it's not just the White House, right? Because administrations change. Our sources mentioned something on the legal side, too.
That's right, which could be more lasting. The Department of Justice, the DOJ, launched what they're calling an Anti-Christian Bias Eradication Task Force.
Think about that name for a second. Eradication Task Force.
Exactly. I mean, the name itself tells you a lot. It formalizes judicial and, importantly, enforcement support. It basically frames any perceived discrimination against Christians or Christian organizations as a really high-priority legal target for the government.
So it gives the full weight of federal law enforcement
to protecting the ideological alignment of, well, the dominant power structure.
Yeah. This really sounds like the whole MAGA movement is shifting gears, moving from maybe more of a populist feeling, a sentiment.
To a codified policy blueprint.
Exactly.
A blueprint.
Precisely. And structurally, it seems the MAGA movement has gained real substance by effectively merging its goals with this thing called Project 2025.
Right, Project 2025. For listeners who haven't tracked it closely, what is that exactly? It's essentially a very comprehensive personnel and policy roadmap. Think of it like a detailed instruction manual designed to help facilitate a massive political transition if and when the opportunity arises.
And it connects back to MAGA how?
Well, that previously maybe somewhat vague slogan, Make America Great Again, is now being explicitly defined within this Project 2025 policy matrix. And the definition points directly to realizing Christian traditional values.
So it signals a pretty clear break from, say, a more secular or value-neutral approach to governing.
Absolutely. It's a very intentional shift.
Okay, so if that's the blueprint and we have these new committees and task forces, what does it look like in practice? How does this affect everyday finance, banking?
The clearest example, the one cited most often in our sources, is the debanking executive order. That was signed back in August.
Debanking, what does that do?
In simple terms, it prevents banks from denying services to customers based on their religious beliefs. It's a direct countermove, really. It addresses past situations or fears of future situations where maybe more progressive financial institutions might have tried to cut off funding or banking services to conservative groups because of disagreements over traditional social views.
Okay, so we've definitely moved past just rhetoric then. We've got a blueprint, Project 2025. We've got new committees, judicial task forces, and now direct executive orders preventing financial discrimination based on a specific ideology.
Correct.
So the big question, how does that translate into making money or maybe more importantly, avoiding risk in this environment?
Well, this shift fundamentally changes the investment landscape because the culture war, as people call it, it's not just a political sideshow anymore. It hasn't been for a while maybe, but now it's really become a new measurable economic sector. It's effectively splitting the U.S. market into, well, you could almost say two distinct competing markets.
Two markets. Okay, let's try and label them for clarity. Maybe something like the patriot economy and the woke economy. Does that work?
That works as shorthand, yeah. So who are the winners in this new structure? If you look at the patriot economy side,
Who benefits?
the beneficiaries are basically those companies that are either explicitly aligned with Washington's dominant ideology right now, or maybe just companies that are clearly not aligned with progressive social causes.
Okay, examples.
Well, you're seeing a definite boom in faith-based investing funds. Their screening criteria often specifically reject companies based on traditional ESG metrics if those metrics clash with conservative values.
Right.
So these companies, the ones that align or at least don't conflict, they're effectively getting a massive policy tailwind.
A policy tailwind. Can you make that a bit more tangible? Like, what does that actually mean for a company?
Sure, it means less regulatory risk, for starters. So if you're a company operating in a sector where the current administration prioritizes conservative values, let's say, you're probably less likely to face aggressive enforcement actions or new mandates on maybe labor practices or new compliance costs tied to certain social programs.
So it's like getting a pass or maybe driving in a lower tax lane on the regulatory highway.
That's a good analogy, yeah. A different, maybe faster lane.
Okay, so on the flip side then, you've got this woke economy. You know, companies that have traditionally focused on ESG, environmental, social governance criteria, and especially things like DEI, diversity, equity, and inclusion, they must be facing some serious headwinds now.
They face a really critical dual threat. It's coming from two directions. First, they've got potential political attacks coming directly from the government. That could be threats of litigation, maybe new taxes aimed at specific initiatives they run.
Okay, so government pressure. What's the other side?
At the same time, they face consumer boycotts.
Yeah.
Pressure from the conservative side of the market from consumers who disagree with their stance.
All right, we've seen examples of that.
Exactly. And this is why the entire definition of ESG itself is under huge pressure right now, particularly the S, the social, and the G, the governance criteria. These parts, which traditionally champion things like inclusion and diversity, well, they now fundamentally clash with new policies, like those allowing exceptions for discrimination based on religious belief.
That must put fund managers in a really tough spot. They're trying to reconcile these older social responsibility metrics with these newer political realities.
It's incredibly difficult. It feels like it's shifting from just measuring risk to almost having to choose a political team, doesn't it?
It really does. So it's no longer just about good governance. It's about political alignment.
Exactly. And that's the central lesson here, really. Policy alignment, political alignment. It's now a critical financial metric. It's not optional. The core question you need to ask when building a portfolio now is, how aligned is this company's values with Washington's dominant ideology?
And that alignment dictates practical things.
Everything, from the specific taxes and regulations they might face, right down to their basic brand perception among potentially half the country. You really can't afford to be socially or politically neutral anymore, it seems. The middle ground is disappearing.
Okay, that's a profound shift here in the U.S. Let's shift gears completely now and look internationally. If the U.S. story is about values getting baked into policy domestically, the China story seems to be about, well, really contradictory economic signals.
That's a good way to put it. Contradictory. It's a tale of extreme hope on one side and extreme caution on the other. It really is a fascinating study in global risk alignment right now.
Bifurcate it, you said earlier, like moving at two different speeds.
It really is bifurcated, yeah.
Yeah.
Moving at two speeds is the perfect description. We've got hard data showing a strong, surprisingly strong industrial rebound.
Hmm.
But that's colliding head-on with consumer data that confirms people are still really reluctant to spend money.
Okay, let's break that down. Let's look at the hope first. The green shoot, as some are calling it. That's this recent positive industrial surprise, right?
That's right. The September official manufacturing PMI, that's the Purchasing Managers Index, it came in at 50.3.
And for listeners not deep in finance, 50 is the magic number.
50 is the dividing line.
Yeah.
Anything above 50 means the manufacturing sector is actually expanding. Anything below means it's contracting. So hitting 50.3, that was the first time it broke above 50 in 7 months.
And it beat expectations.
Decisively. The market was expecting something like 49.8, still in contraction.
Yeah.
So 50.3 was a massive signal of renewed industrial momentum, a really positive surprise.
And is this just like basic factories churning out cheap goods again, or something more?
That's the crucial part. This isn't just a broad low-tech rebound. The source data suggests the growth is really being fueled by sophisticated advanced manufacturing.
Okay, like what?
Well, if you look at the August industrial profits data, it confirmed that the growth is being driven by high-tech sectors, particularly things like electrical machinery and equipment that surged by nearly 99%.
Wow, 99%.
Yeah. It shows us that Beijing's industrial policy, their focus on moving up the value chain, is actually succeeding. They're pushing hard into areas like robotics, industrial automation, green technologies, areas that directly challenge traditional Western industrial dominance.
Okay, that sounds like a roaring recovery on the industrial side then. So why are Chinese consumers acting like they're still stuck in a recession? We saw that strange data from the Golden Week holiday recently. Travel volume was huge, record-breaking apparently. People were definitely out and about.
Yeah, they were moving.
Yeah.
But you have to look at their wallets, not just the number of tourists on trains or planes. The initial spending data from that holiday was incredibly telling.
What did it show?
While the total amount spent rose, because so many people traveled, the per capita spending, how much each person spent on average, was actually 5 to 7% lower than it was back in 2019, before the pandemic.
Lower than 2019. Okay, that confirms this consumption downgrade idea is real then.
Absolutely real. It's happening.
So it's like that clipping coupons analogy we talked about before. People are traveling, but they're doing it on the cheap.
Exactly. They're taking budget trips, maybe choosing affordable local restaurant chains instead of high-end dining. They're putting off buying big-ticket items like new cars or major home upgrades.
And why? Just general caution, worries about the future.
It seems to boil down to worries about jobs and future income security. There's still a layer of uncertainty that's making households prioritize saving over spending, even if they feel okay enough to take a trip.
So that's the dynamic then. You've got this recovery being driven almost entirely by state-led advanced manufacturing, dictated by government investment, pouring money into national champions.
Right. The part the government controls directly is booming.
Meanwhile, the part of the economy that relies on how regular households feel, let's call it consumer-led services, that's lagging behind. Because people are just playing it safe with their money.
That's the split in a nutshell. State-led boom, consumer-led caution.
Okay, so given this major contradiction, this manufacturing giant with this really cautious population, let's talk strategy. For years, we heard nonstop about decoupling from China, about capital pulling out.
Right. Big outflows.
Yet our sources are indicating that foreign capital might actually be starting to return. Why now? Are investors buying into this state-led recovery story, or are they just seeing maybe deeply depressed asset prices and dipping a toe back in?
It's probably a bit of both, honestly. Bargain hunting is likely part of it. But there was also a really significant policy catalyst recently that seems to have lowered the perceived risk for foreign investors.
Oh, really? What was that?
Several major investment banks pointed specifically to China's declaration on September 24th. They announced they would voluntarily give up their developing country status at the World Trade Organization, the WTO.
That sounds like a fairly minor, maybe procedural change. Why would that be such a big deal for investors?
Because it signals genuine political flexibility from Beijing, which investors haven't seen much of lately. It's being viewed as a really crucial step towards potentially restoring international confidence, maybe easing some of those U.S.-China tensions.
Ah, so it lowers the geopolitical risk premium, that extra risk factor priced into Chinese assets.
Exactly. It tells the West, essentially, look, we are prepared to negotiate, we're willing to adapt to global norms. It was seen as a significant conciliatory signal.
Okay, that makes sense. So if investors accept this two-speed reality in China, where should they focus their capital? You clearly can't just bet on China broadly anymore. You have to bet on the right speed, the right part of China.
Absolutely. The first step is to prioritize the policy beneficiaries. Look for those sectors that are clearly receiving centralized government investment and support.
Like the advanced manufacturing we talked about.
Precisely. Advanced equipment makers, industrial automation companies, firms involved in building out the domestic semiconductor supply chain, trying to become self-sufficient there. Also areas like shipbuilding, maybe aerospace. These sectors have the most powerful growth engine possible behind them right now, the Chinese state itself.
Okay. What about the huge global AI rally? Everyone's excited about AI. How does China play into that, especially when they face significant U.S. restrictions on getting the most cutting-edge chips?
You have to be incredibly nuanced here. It's probably wise to avoid vague bets on, say, Chinese AI software development, because that's often directly hampered by the U.S. sanctions on chips and technology transfer.
So focus elsewhere.
Instead, focus on the hardware and components, the things essential for building the actual AI infrastructure that is allowed and being heavily invested in domestically.
Like the picks and shovels for the AI gold rush.
Exactly like that. Think about things like optical transceivers needed for data centers, advanced power systems, specialized cooling solutions. These are foundational necessities for building domestic computing power. They're often less susceptible to direct sanctions, and they directly benefit from that state investment push.
Got it. Okay, finally, let's circle back to the consumer side. If people are clipping coupons, how do you successfully invest in that cautious consumer?
Well, you definitely avoid luxury goods for the most part. The strategy is to target value for money.
Value for money.
Focus on brands that offer demonstrably high quality, but at a reasonable, affordable price point. Or look at platforms offering affordable local entertainment and travel options. Basically, you capitalize on the consumption downgrade.
So you back the winners who appeal to that cautious, budget-conscious majority?
Exactly. The majority who still want to live their lives, go out, have experiences, just more affordably. Think of it maybe as betting on the growth of the Chinese equivalent of Walmart or Target, not Neiman Marcus.
That's a very clear analogy. Okay, this has been a really compelling deep dive. We've covered two huge takeaways here, it seems.
Yeah.
First, the U.S. political scene and the economy are now inseparable, really, creating almost two distinct domestic markets, governed by increasingly different rules and values.
Right. And second, internationally, China's growth story is moving at two very different speeds. You've got that powerful state-led industrial growth clashing with significant consumer hesitancy.
So the central lesson for you, the listener listening to all this.
I think the central lesson is this. Investors simply cannot afford to view politics or social values as somehow external variables anymore, things you could ignore or factor out of your market analysis.
They're fundamental now.
They are now fundamental drivers of regulation, of risk, and ultimately of profit. That's true both domestically here in the U.S. and internationally in a place like China. Understanding that policy alignment, that values alignment, is now just as crucial as understanding a company's balance sheet, maybe even more so in some cases.
Absolutely. A crucial shift in perspective needed. And that leaves us with maybe one final thought for you to mull over.
Okay.
If this patriot economy truly becomes the dominant regulatory and financial force here in the U.S., does that trend, that move towards politically aligned investing, does it inevitably spread globally? Could it force every major multinational company, think tech giants, fast food chains, everyone to eventually have to choose a side, even if only subtly when they make hiring decisions, manufacturing choices, or brand decisions anywhere in the world?
That's a big question. Do they all have to pick a team globally?
Something to consider until our next deep dive.